This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Okay, this lecture is on Chapter 10 of the free lecture notes of paper F2 and is on marginal costing. Now, I hope you have been through the previous chapter in the lectures where I went through absorption costing. And assuming you have, you will remember that there was that little problem that with absorption costing, we say, the profit's going to be, I think it was $8 a unit. But because we'd absorbed the fixed overheads, we needed that adjustment for any over-under absorption. And so there is an alternative way, which some people prefer. We'll talk about pros and cons after, where instead of messing around and absorbing fixed overheads and then having to adjust, we effectively, as you'll see in a minute, keep them separate and say, well, the fixed overheads are going to be fixed, so why mess around? And let me show you what I mean straight with the example. If you look at example 1 on the second page, it's exactly the same example that we did in chapter 9, but this time we're going to do it marginal costing. And so part A says prepare a cost card. Well, let's do the cost card. XPLC produces one product, desks. The cost card, each desk requires 4 kilos of wood. So just as before, we've got materials, 4 kilos. It costs $3 a kilo. So the cost per unit for materials is $12. In addition, we've got labour, 4 hours, $2 an hour, so $8 a unit. And in addition, variable production overheads, $5 a unit. And on our cost card, remember, we're only concerned with the production costs, so variable production overheads. Any selling costs for the minute are irrelevant. When we did absorption costing, we also brought in the fixed overheads, but this time we're going to leave them out. We won't ignore them completely. Obviously, fixed overheads will affect our profit, but we're not going to absorb them because that's where all the problems occurred. And so with marginal costing, our cost card stops there. We've got a total of 25. And that 25 is the total variable cost of production, or the marginal cost. So the marginal cost of production, 25, or the variable cost of production. Now there's our cost card, but let's go slightly further. In that we know what the selling price is. Per unit, the selling price is fixed at 35. And so if the selling price is 35, well, we've got the marginal cost of production of 25 a unit. And are there any other variable costs? Yes, there are. There's a variable selling cost of $1 a unit. And so we say, well, if we ignore for the moment any fixed costs completely, we're making a final profit of, I think, what does it come to? 35.10 of $9 per unit. And that $9, I say again, is the final profit we're making, ignoring fixed costs. And we call that the contribution. And that word is desperately important. The contribution, you can express it in two ways. It's the selling price less all variable costs I say all, usually in exam questions of this type, there are no selling costs. The only costs are production costs. But I just wanted to make it clear, the contribution is the selling price less all variable costs. Or another way of putting it, it's the profit before any fixed costs. And so we're not bringing in fixed costs at all. So we've none of that absorbing profit problem. And therefore, in this question, every single unit we sell should give us a profit before fixed costs, a contribution of $9. And so let's carry on with part B. It says set out profit statements. Now again, I will do a profit statement in a moment. But let's see, just for January, how much profit do we expect to make? In January, well, we're selling 9,000 units. The contribution per unit is $9. So that means we expect a profit of 81,000 before any fixed costs. So that's the contribution that we're budgeting on. And of course, the final profit, we will subtract the fixed costs. And there are two. There are production fixed costs of how much? 20,000. There are selling fixed costs of, I've lost it, 2,000 a month. So total 22,000, giving a final profit of 59,000. Beautiful, no problem. And none of that business about absorbing the wrong number of fixed overheads and then having to adjust it. The contribution will be $9 for every unit sold. And then we subtract whatever the fixed costs are. We get them correct first time, sort of thing. In that sense, it's much easier. And the question actually asks for a full profit statement. Well, because I need to illustrate something else, I will write up a full profit statement. But as I said when we did absorption costing, you can't be asked to write up a full profit statement in the exam. If you were asked for this question, what's the profit for January? Well, you'd be stupid to do anything other than what I've done there. However, I will do it, a full profit statement. So off we go, but just look at the way the layout changes a bit. First of all, our sales. We're going to sell 9,000 units. The selling price, 35 a unit. So the revenue, 9,000 at 35, 315,000. We subtract the cost of the goods sold. And like before, we'll take the cost of what we produce less the cost of any closing inventory. So the production is 11,000 units. And the costs, well, materials, 11,000, and what was it per unit? $12. We've got labour, 11,000 at, from the cost card again, $8. The variable overheads, I can remember then it was $5. But for the moment, we stop there. For the moment, we only bring in the variable costs of production. Yet again, we're not going to absorb these fixed costs. So the variable cost of production, 132,000, 88,000, 55,000 is 275,000. But that's the cost of the 11,000 we produced. Again, I could have written that straight down, of course, because we produced 11,000 units. And the variable cost from the cost card is 25 a unit. Well, 11,000 at 25 is 275,000. However, that's the cost of the 11,000 produced. To get the cost of the 9,000 sold, we subtract the closing inventory. And if we produce 11 and only sell 9, we've 2,000 left in inventory. And they'll be valued at the marginal cost, the variable cost of production, 25 a unit. 2,025 is 50,000, giving a cost of sales of 225. And so our profit so far, sales of 315 less cost of sales 225 is 90,000. However, that itself doesn't have a name. It's like the gross profit before any fixed costs. But we then subtract any other variable costs. And here there were selling costs. They're $1 a unit, but they'll vary with the number of units sold. So 9,000 at $1. 9,000, bringing us down to 81,000. And of course, that 81,000, that's our profit before fixed costs. That is our total contribution. Now, although I've not finished it yet, please let me repeat, you won't be asked to do a full profit statement. And secondly, it's very rare in exam questions for there to be any other variable costs. So normally that 9,000 wouldn't be there, and the contribution would simply be 90. But it is important to be clear, contributions after all variable costs. Having got the 81, all that remains is to subtract the fixed costs. And what were they? Again, none of this absorbing and changing. We were budgeting on production fixed costs of 20,000, selling fixed costs of 2,000. And therefore, the final profit, 59,000. So, in a lot of ways, so much easier, of course. And again, no need for all the business up at the top. I said earlier, if you were just asked what the profit is, well, since we know the contribution is $9 a unit, we could have written the 81,000 straight down. 9,000 units sold at $9. Subtract the fixed costs. And there we are, there's our profit. All right, well, that's beautiful. But before we quickly look at February, you may have noticed one little problem. We've got a profit there of 59,000. But if you do look back to what we did in the previous chapter, when we used absorption costing, Look back, or trust me, but we did do it in chapter 9. But when we did absorption costing, we got a profit of 63,000. We've ended up with a different profit. Now, it's not a question of right or wrong. You know, some people prefer to do absorption costing, some people prefer to do marginal costing, but they do end up with different profits. And why? Because although the layout of the statement has been a bit different, if you look back to chapter 9, the sales revenue in both cases was 315,000. The materials were 132, labour 88, variable 55. The fixed costs, all right, when we did absorption, we put in the wrong figure and then we adjusted it, but we did end up with 20. We did end up with selling costs of 2,000 and 9,000. The figures are all the same, except for one thing, the inventories. Again, I can't wind back now to chapter 9, but the closing inventory, there were 2,000 units. In marginal costing, we valued them at $25 a unit. If you look back to chapter 9, when we did absorption costing, the cost card included fixed overheads, and they were valued at 27 a unit. And obviously, surely, if you value your closing inventory different, you're bound to end up with different profits. But the only reason the profits are different is because of the way we value closing inventory. And the only reason we value closing inventory differently is that on absorption cost card, we bring in the fixed overheads, which in this question were $2 a unit. With marginal costing, we don't bring in the fixed overheads. And if you look at example 2, but just January, there's a little table there which I'll fill in. When we did absorption costing, trust me, we did end up with a profit of 63,000. It's the same question. Look back at the lecture or look at the answer at the back of the notes. But when we do marginal costing, which we've just done, we get a profit of 59,000. The difference is 4,000. And as I say, the only reason ever for that difference is due to the way inventory is valued. That difference is the change in inventory multiplied by the fixed overheads per unit. How much did the inventory change by here? We produced 11,000. We only sold 9,000. So the inventory increased by 2,000 units. What were the fixed overheads per unit when we did absorption costing? With absorption costing, they were $2 a unit. And therefore, the profits will be different by 4,000. Now, I say again, it's not a question of which is right, which is wrong. For management accounting, we do whatever we like. Some people prefer absorption costing, some people prefer marginal costing. It doesn't matter, but they will give different profits. Out of interest, financial accounts, there are rules, and with financial accounts, you have to bring in all costs of production. It is effectively absorption costing. But again, management accounts, it's our choice. But do appreciate there will be a difference because you are bound to be examined on that in the exam. Very, very commonly, you know, they might give you the absorption profit, say the absorption profit is 63,000. They might tell you that inventory's changed and the fixed overheads per unit are 2. And they'll say, what would the profit be using marginal costing? Well, it'll be 4,000 different. To complete both examples, let's look at February. And again, this time, I am not going to do a full profit statement. If you want to do one to check yourself, have a go. There's an answer at the back. I'm not going to do it. Let's do it like it would be in the exam, just saying what is the budgeted profit. The budgeted profit in February, well, first of all, the contribution. It's however many we sold, which is 11,500, times the contribution per unit, which we worked out earlier, $9. And so the total budgeted contribution, 11,500 at 9, 103,500. To get the profit, subtract the fixed costs. And again, no messing around. The production fixed costs, I keep forgetting, 20,000. The selling fixed costs, 2,000. And therefore, using marginal costing, we have a budgeted profit for February of 81,500. So nice and easy. And for a third, fourth time, none of this messing around, putting in the wrong figure for fixed overheads and then the under-over absorption. Fixed overheads going at the end with the right figure. I don't know, in that sense, it's certainly much easier. Again, let's compare the two. For February, marginal costing gave 81,500. If you look back to chapter 9 or the answers at the back, you'll find when we did absorption costing, we got a profit of 77,500. And so again, there's a difference. There'll always be a difference. The difference here again is 4,000. And why? Because again, the only reason ever for the difference, the change in inventory over the period times fixed overheads per unit. And how much did the inventory change by? This time we sold 2,000 more than we produced. So the inventory will have fallen by 2,000 units. The fixed cost per unit when we absorbed were $2. And so the difference is 4,000. In the long term, marginal absorption will be the same. It doesn't make any difference. But month by month, there'll always be that difference due to the change in inventory. One other thing here, do note in January, inventories increased. We produced more than we sold. Inventories increased and absorption gave the higher profit. In February, inventories fell because we sold more than we produced. The inventory fell and marginal gave the higher profit. Now check you see what I mean, but do learn example 3 here. Example 3, it says compare profits to the following situations. A, if the production is more than the sales, well, if you produce more than you sell, the inventory increases. And if inventories increase, well, you can see for yourself in January. In January, where was that table? There we are. In January, inventories increased and absorption gave the higher profit. Secondly, if it's the other way around, if production is less than the sales, well, if you're selling more than you produce, the inventory will fall, not decreases. And look back at February, convince yourself, but in that case, marginal will give the higher profit. Finally, I said, we always get different profits. In fact, there's one case when you don't, which is C. If production equals the sales, well, of course, if you're selling exactly the same amount as you produce, there's no change in inventory. And if there's no change in inventory, well, there'll be no difference in the profits. The profits will be the same. I think you can take my word for that. If you're at all unconvinced, make up, go back to example 1 and make up a figure for March. Have in March produce 10,000, sell 10,000. Do it both ways and you'll find that that's the one time when both methods give the same profit. All right, well, those last 2 chapters are desperately important. Marginal absorption costing. You're bound to get several questions in the exam testing you on over-under absorption, testing you on the fact that profits are different, testing you on what contribution is. So do make sure that you've gone back through them. And of course, do have a go at the online test on this chapter.